What we're talking about are the businesses that were created over the last handful of years when times were really easy, money was being given away for free, and they were able to really add a lot of employees and think that they had everything going well for them. And now you might see some of those businesses really start to trail off.
The major theme of our discussion will be recession investing, which sectors to avoid and which sectors may survive what's coming. Chance Finucane joins us today. He is the Chief Investment Officer of Oxbow Advisors. Chance, welcome to the show. Pleasure to host you today.
Yeah, David, great to be here.
I want to start by following up on what Ted Oakley, founder of Oxbow Advisors, told me last time he was on the show.
A lot of those will go out of business. I mean, if you look at the number of zombie companies, for example, in the Russell 3000, you'll find there's more than you think. And it's probably 1 out of 6, 1 out of 5. And those companies are probably gone. I mean, they can't get financing because if you don't have any revenues or any earnings, it's going to be very hard for you to get financing. I think that's what you're running up against.
Now, we didn't have a chance to drill down on the particulars, so I'll start by asking you which sectors are most likely going to be classified or be categorized as zombie companies?
Yeah, we put those in two different buckets. So one would be companies that aren't generating any real, even operating cash flow, much less free cash flow. And you tend to see that in the consumer discretionary and tech sectors with businesses that have not really found a way to generate a profit on sales to their current customers. So anything like that you're just seeing that they're not generating any cash flow whatsoever, they might have a little bit of runway with some money that they raised over the last few years, but as that cash gets burned out of the system, they're not going to have much ability to really raise through any sort of lending going forward. And that's where we might see that happen. The other area is businesses that have a lot of financial leverage. And this could be across any number of sectors with companies that have mismanaged their balance sheet. But really, we try to stay away from any junk-rated companies that have a lot of debt on their balance sheet during this time in the cycle when you want to be sure that the companies you own can make it through a recession and come out to the other side.
Just in the first point, you've described a lot of startups. At any given point, startups typically have cash from seed funding or perhaps whichever round they've done, but very little in terms of operating revenues because they haven't started yet. Doesn't necessarily mean they're bad companies. And if we just to play devil's advocate, if we were to apply the same logic, that we would have never invested in Google or Amazon in its early days, I guess.
Yeah, you're correct. Actually, I think one thing we'll see is companies, let's say we go through a stretch here for the next year or two where it is a very difficult economic period. A lot of the biggest success stories in American commerce were businesses that were started during a recession. And because of that, the founders of those companies had to be very versatile and find a way to just sort of bootstrap their way through the slow starting period. But that resourcefulness allowed them to figure out who their core customer was going to be, how to generate a profit quickly, and then scale the business from there. What we're talking about are the businesses that were created over the last handful of years when times were really easy, money was being given away for free, and they were able to really add a lot of employees and think that they had everything going well for them. And now you might see some of those businesses really start to trail off.
Do you know roughly how much of the Russell 3000, for example, would be classified as a zombie company under this definition?
It's a pretty high percentage. I don't know if you have it offhand, but I'd say it's probably somewhere close to 10 or 20% of the businesses would fit that category.
Yeah, I think Ted told me something like 1 in 5, 1 in 6. So okay, that is very scary, Chance. And on the second category of companies that hold a lot of debt on their balance sheet, how much of that debt on average, I mean, it varies company to company, of course, I'm generalizing here, but how much of this debt that we've seen accumulate on the corporate balance sheets can be rolled over at lower interest rates than what we might think? Meaning, can they keep their past interest rates locked in from before, or would they have to be forced to refinance at higher rates now?
In almost every case we see, they will have to refinance at a higher interest rate. And we will give these public companies credit. A lot of them saw the writing on the wall over the last 5 or 10 years and locked in a lot of longer term debt at lower fixed rates. But over the course of the next few years, some of those loans they took out are going to mature. They'll likely need to refinance. And in almost every case, that next interest rate that they get on the next loan is going to be higher than the previous one. And that's just going to add, beyond just the zombie company issue and the bad balance sheets, it's going to be a headwind for earnings per share growth because you're going to have higher interest expense for a lot of these companies in the next handful of years to come.
Have we seen this level of debt escalation in the past, Chance?
Not to my memory. So it's really been a trend over the last, say, 4 decades. As interest rates have come down, it's almost been like a financial formula that a lot of CFOs at these large companies have figured out, that you can add some debt onto your balance sheet at low interest rates, use that cash that you get from the debt to buy back stock to inflate your earnings per share. And there are certain sectors where we've seen this a lot, whether it's the restaurant industry after they franchise all of their stores and end up using the debt they get to be able to buy back shares. You saw it in the cable and satellite industry. It was happening with the media companies before Netflix came in and totally disrupted that model. It works for a certain period of time, but if you're not reinvesting in the strength of what you have to offer to your customers and how you differentiate from your competition, eventually it catches up to you. So it can work as long as you're still reinvesting, but we're always wary if a management team is relying too much on that, take out debt, roll it back into buybacks, and hope that it keeps working in your favor.
Generally speaking, Chance, when a company is preoccupied with paying off interest expenses, how does that change their core operations? How does that change the priorities of management?
It's almost like you're unwinding the tailwinds of what they had. So, for instance, there will be companies, we actually saw this with some of the retailers like Macy's or Kohl's or Nordstrom. They were doing this where they could try and keep their balance sheet, their net debt to EBITDA at a certain ratio. And so as their profits grew, they could take out more debt, use that additional debt to buy back stock. And because of that, they grew their earnings at a faster rate. The problem is once your operations start to not grow and that EBITDA starts to decline, now you have to start reducing your debt, but you have less cash available to pay down the debt to keep your debt ratios at a level that would be considered investment grade. And as that starts to go the other direction, instead of the sort of virtuous cycle that you had before, then you end up drifting into being junk rated, getting downgraded, shareholders start selling your shares, and it's really hard to escape from that.
So going back to these zombie companies, what is the catalyst, do you think, for a bunch of these to start going bankrupt?
It'll come up over the course of the next several years, as long as interest rates stay at this level and lending staying tight like it is today, because it's not all going to happen at once. Companies are going to need to raise new equity or they're going to need to refinance debt at different times. But as long as you see venture capital and private equity firms starting to pull back from offering as much financing or as much equity, and as you start to see banks pull back on lending to some of these companies as they need to refinance, that's where you're going to see things start to be an issue. So we would expect it to be sort of an ongoing, continual problem for several years.
All right. Well, let's talk about what you do like, and then we'll move on to the economic outlook that your firm has. So walk us through the sectors, rather, that you think will do well during what you believe is going to be a coming recession.
Yeah, so when you're heading into a recession, usually the places that tend to do well in this environment, one would be treasuries, both short-term and long-term treasuries on the fixed income side. Another one would be gold and gold-related equities, and we've had an allocation to that for quite some time now in our high-income strategy. And then the last one is within equity sectors, it tends to be the defensive sectors. So consumer staples, healthcare, and utilities are going to be a relative outperforming space compared to sectors in the rest of the stock market. Now, you don't have to own those specific equity sectors unless you need to be fully invested at all times, which some mutual funds and ETFs have that mandate. For us, we're just looking for the best way to generate some return with as low risk as possible. So right now, with where the stock market is currently trading at over 18 times forward earnings, there's probably only like a 5 to 7% annual return expected over the next 5 years if things progress in a normal way. And if you compare that to being able to get a 5% yield on short-term treasuries right now, We would rather just own the 5% yield in treasuries and wait for a better entry point to see what happens with these negative implications for the economy that are on the horizon.
You said that there's a possibility that companies would experience higher interest expenses on the condition that, of course, interest rates stay high and elevated, and of course, over the next coming years, you'll experience a wave of bankruptcies. Well, are you not assuming then, Chance, that interest rates will come down during a recession, that the Federal Reserve will not cut into a recession?
So there's two different parts to the treasury curve. There's the short-term treasuries, which tend to move with Federal Reserve policy. So if and when a recession really starts and the Fed has to take notice of that and they can't continue to just focus on fighting inflation, they just are trying to keep their rates high on the short term for as long as possible because inflation is still sitting there at 5% year over year. The long-term treasury bonds tend to move with changes in economic growth and the economic forecast. And we're seeing growth continue to slow down. Inflation is high, but it is coming down from its peak in the middle of last year. So we would actually expect long-term treasury bond yields to come down and the value of those bonds to go up in price. So the issue, circling back to what we were talking about with zombie companies and having to refinance, even if, let's say, the 10-year treasury bond yield comes down, in that sort of environment during a recession, the spread between high yield bonds and the treasury bonds is going to widen. So even if, let's say, the 10-year treasury yield goes from being above 4% last year to down to 2.5% in the months or quarters to come, you could have a 7.5% spread or higher. It could be a 10% spread between the yield of a junk bond versus a treasury. So it could actually be a higher rate that a junk rated company has to refinance at, with 10% or 12% compared to what they were locking in at 4 or 5 or 6% a couple of years ago. That's going to be a real headwind, even though the treasury bond yield has come down.
Just sidetracking for a minute. Have you noticed the any changes in the corporate spreads due to the ongoing debt ceiling dilemma that Congress and the Treasury seem to be facing?
There's two areas where we've noticed it. So one is the credit default swap rate that you see just for U.S. sovereign government debt. And you've seen that really spike since December. It's still pricing in that very likely the government will be able to come to an agreement to raise the debt ceiling, although they'll probably wait till the last possible minute to make that announcement and come to a deal. The last time this happened in a big way was 2011, and they finally came to an agreement just 2 days before the ceiling was going to be hit. So we wouldn't expect anything to really happen until the end of this month, if in fact June 1st is sort of the day that they have to get it done by. But the other area we're noticing it is the spread on investment grade financial sector bonds is widening. And we think that started back in March as we just saw 3 large banks go under, and we're starting to see some more weakness with smaller regional banks that are going through some of the same issues. And this is right about at the level right now where we were in 2007 and in 2001 before entering those previous couple of recessions.
Have you noticed any changes in dividend yields in some of the larger companies that you've looked at?
Yeah, I'm glad you asked that, because one thing we noticed in recent years, especially in our high income strategy, where we're trying to beat the bond market and generate a mid-single digit return and a mid-single digit dividend yield for clients across an array of asset classes, it was really difficult for a number of years to find anything with good quality that had above a 5% dividend yield. But today, when you have short-term treasuries yielding 5%, there are a number of securities that we see with yields of 6%, 7%, or 8% that we think those dividends are sustainable. The valuations of these securities are reasonable. And that's where we've been allocating a lot of our clients' assets. So some areas that fit that, there are some REITs that yield over 6% that we think are sustainable to be able to hang on to that. They avoid the areas of the real estate market that we think are the most suspect. Another area would be wireless telecom. So Verizon and AT&T really streamlined their businesses. They're just focused on their wireless networks. And we think the cash flow they generate, they'll be able to pay out their 6.5% or 7% dividend yield. And then within the energy sector, the pipelines are paying out 6 to 8% dividend yields. and they're generating a lot of free cash flow while having improved their balance sheets in a significant way. So we think that's a decent place to be, since their cash flows are derived from the volume of natural gas or oil running through their pipes, rather than what the underlying price of oil or natural gas is going to be.
Just on a note on real estate, you said you're avoiding the areas that are suspect. Which areas are most suspect, Chance?
I think everyone would know that office is definitely the area that is just, it's been interesting to follow this trend towards returning to the office. But I think where people might have been expecting that we were going to get back to everyone going to the office 4 or 5 days a week, it seems like in the major cities, we've stalled at only a 50 or 60% return to the office rate, where people are maybe coming back Tuesday to Thursday, but they're working from home on Monday and Friday. And just looking at the comparison between private market values for office assets and public market, like public REITs, in the private market, the value of office buildings has fallen by about 25%, but the public REITs always move faster than the private valuations. And if you look at what's being discounted in the public office REITs that are trading right now, they're down 50 to 55% is what they're implying for the value of these office assets that they own. So it's an area that we just think is going through a structural change, and is not one that we're trying to jump into, while a lot of those public office REITs are cutting their dividends.
So you don't think they're either oversold or unfairly valued right now, given current inventory levels, and perhaps not pricing in an economic recovery in a few years?
We wouldn't jump in at this time. The problem, especially for the publicly traded office REITs, is that their primary exposure is in the largest coastal cities, where we're seeing the biggest change in this secular trend. So maybe in some of the other parts of the United States, there might be more of a recovery in some of those office assets. But when it comes to New York, San Francisco, LA, we're less interested in trying to get into that space. We'd rather stay in subsectors within the real estate market, such as healthcare, where there was this headwind of having to pay extra for healthcare related labor, just because of the shortage of nurses and other healthcare specialists. That headwind is dissipating. So we're actually seeing an improvement in metrics there. And then another area where we've been allocating some is the self-storage REIT sector, which had a really boom period that's now tailed off. And the prices of those publicly traded self-storage REITs have come down by a huge amount. But we actually think trends are starting to stabilize. Public Storage, which is the largest self-storage REIT on the public market, just came out and reiterated its guidance for the rest of this year. So we think that's one that being able to get in at a good valuation and get a good dividend yield is a good place to be too.
How bad do you think this coming recession is going to make real estate, in particular commercial real estate? You're not the only person to voice these concerns. Prominent investors within all sectors have shared similar concerns. Charlie Munger has spoken out against commercial real estate. Elon Musk has warned against the dangers of commercial real estate for many of the same reasons that you brought up. And I'm wondering how severe this downturn could be. People talk about 2008 as the benchmark for real estate collapses, but we saw most of that happening on the residential side.
Yeah, there is a difference. So it's not to the same scale as what we saw in the financial crisis in 2008. So just to put it in perspective, residential real estate was about 6.5% of GDP at that point in the mid to late 2000s. Commercial real estate today is, say, about 2.5% of GDP. So it's a little less than half of the scale of what the residential real estate market was. So we wouldn't expect the bubble to be as large as what we saw on the residential side 15 or 20 years ago. But the two problems you have that need to be unwound, one is there's too much supply that was being built out and constructed to go into the system. And we're seeing that with record units under construction in the multifamily apartment space. You've still got the oversupply in the office space as businesses are trying to bring down how much office space they need in a hybrid working environment. So there's areas like that that you really just want to pay close attention to. There's some other legacy commercial real estate assets like malls that are probably going to continue to be downsized and try to be repurposed, but that's going to be expensive to do. So we're really just trying to pick certain areas of the market and certain geographies to be focused on, rather than trying to time when there's going to be some sort of a turnaround.
Uh, it's interesting the ripple effect that a slowdown in commercial real estate could have. I'll give you a personal anecdote. So in Canada, where I'm from, I was talking to a convenience store owner, and I was asking him about how business is, and he said, "Well, it's only good on some days when the office workers go back to the office," meaning on most days when people aren't back to the office, he doesn't have people coming in, and that wasn't really the case a few years ago when before the pandemic everyone had to be at the office. So that leads me to my next question about small businesses, the engine of growth in America. You have a slide here on one of your investor presentations. It's titled "Small Business Growth is Stagnant." And you're showing a chart from the NFIB. They do a collection of surveys, and one of them here is that small businesses are reporting loans being harder to get. And this trend has been rising since early 2021, not quite yet at 2008 levels. Is this usually in the past? I'm just looking at this chart. It seems to me that it's usually been in the past a precursor to recessions. Is that true?
Yeah, that's the way that we view it as well. So that was one data point. We've seen numerous others that suggest another one we just saw this morning, I believe also from another NFIB survey, is 2/3 of small businesses get their loans from small to medium-sized banks, and only 14% of small businesses have access to large banks, the ones that are still hanging on to their deposits in the midst of this sort of looming bank crisis. So for small businesses, it's a real problem that these smaller banks are trying to figure out how large their deposit base is going to be. They've really pulled back on doing any loans, and that's going to affect the growth plans for small businesses that drive the majority of growth and employment in America. And that's really where, when we see something like this and the trend is heading this direction, it's hard to turn that on a dime. This is something that's going to likely continue for quarters to come. And as you said, tends to be a precursor to a recession setting in.
Okay, well, you brought up banks. So the underlying assumption here is that the regional banks are still mired in difficulties, if I may put it that way, which, like you said, because of their exposure to small businesses may impact the small business sectors. Is that still the case? Is the banking crisis still ongoing, Chance?
Yeah, we believe so. And actually, we were just talking about this with someone in our office recently. There's a handful of areas that make us reticent to look at this drawdown in bank share prices and consider it an opportunity. So we just talked about the reduction in lending to small businesses. There's a lot of exposure to commercial real estate, especially for the smaller regional banks. There's the issue of really no profit margin anymore on their net interest. So the gap between what they're able to loan out at and then trying to make a profit on that relative to the deposit rate they pay to customers, that gap has pretty much gone to zero. So it's going to be difficult to generate profits even for the banks that can survive through this period. Then they also have to recognize more provisions for loan losses, because we're heading in that direction now where the number of bankruptcies announced across corporations this year are nearly 40% higher versus this time last year, which is the highest increase in corporate bankruptcies going back to July 2009. So they're going to have to increase their provision for loan losses, which also hurts their earnings per share, which makes it difficult for them to find a bottom in their share prices. So you just look at all this, and it's just going to be difficult to see them being able to escape out of this immediately. And right now, it's just a lot of volatility where PacWest Bank is one that we keep an eye on after the three that have already gone bankrupt. This is the next one we're keeping a close watch on. And it seems like every day it's either down or up by 5 or 10%. And that's not healthy activity. That's investors trying to figure out what's going to happen next and what's the next shoe to drop.
From an investment standpoint, are you concerned about everything you've just described? From a longer term perspective, we've seen consolidation in the banking sector happening for decades. There used to be a lot more banks, in the order of more than, I think, 14,000 banks in the U.S., regional banks, and now there's only a couple thousand. And I think that number will continue coming down because of what's happening right now. Generally speaking, though, we haven't seen the entire financial system collapse because of this consolidation. One would argue this is just a long-term trend. How would you respond to that?
You're right that it's a long-term trend. So your numbers are right. 40 years ago, there were almost 18,000 banks in the United States. And that's not individual branches, that's corporations. And now it's down to about 4,000. So it's come down by about 75% over the last 40 years. But you still have more than 4,000 banks here. And that is such an outlier compared to the other 20 largest countries in the world in terms of business and GDP. The most you'll see is, I think, about 325. So there are more than 10 times as many banks here in the US than there are in any other large country in the world. So it works as long as these smaller banks are able to know that their deposit base is solid and they can lend off of that base. But if they're not sure what they have to do to give incentive to customers to keep their deposits at the bank, they're not going to feel as confident lending. And if that's going to lead to more consolidation, more buyouts, and we're just drifting towards the very largest banks having the biggest portion of the assets, that's an issue for small businesses because they do less than 20% of the small business lending across the US. So either those large banks are going to have to start doing more small business lending, or we're going to have to find a way to preserve some of the regional banks that provide that.
Just a note on margins. You have an interesting slide here on margins, operating margins, in one of your presentations. Now, it's labeled operating margins are still extended. And I'd like to comment on that. Do you think that during a recession, and recessions are typically disinflationary events, margins in some sectors may actually increase? I'm just posing a theory here. Consider that raw materials have been coming down, lumber, oil, natural gas, and wages are, going into a recession, wages aren't going to be growing at a fast pace. Typically, it's going to be sticky. It's not going to come down, but it's not going to be growing. And so companies are facing this interesting conundrum where on the one hand, you've got a slowing economy, but on the other hand, perhaps input costs are coming down. How does all this play into margins?
Yeah, so typically a recession, you'll still see margins continue to come down. And right now, so what's caused the fall from the record margins so far, we've still seen about 4% revenue growth across all the largest companies in the US, but the earnings growth are down because of the margin hit. So like you said, that's mainly just higher costs. When you get to a true recession where inflation will start to fall a bit further and you'll see just overall real GDP growth turn negative, that's going to really hit the actual revenue growth. So right now, if we're at 4%, you could see that fall even lower. And for specific categories or sectors that are cyclical, you're going to see an actual decline in revenue. And just the way that a typical income statement works, you'll have companies that might only report a 3 or 4% revenue decline, but might have a 10 or 15% decline in their profits because of just the scale and leverage. It works in your favor when you're growing, but then it goes the opposite direction when your revenue's in decline. And that's the reason why we're being very wary about those cyclical sectors like consumer discretionary, autos, financials, energy, industrials, and then any cyclical commodities business with exposure to some of the areas you're talking about, like copper or aluminum, things like that.
I'm going to wrap up on 2 more slides here. Now, Chance, just on the note of consumer discretionary sectors not doing well, you have a very scary slide. It's called Households Out of Excess Savings by the Summer. Can you tell us about this slide? You've got on the top panel, U.S. real personal savings as a nominal number. It's been coming down the trend. And then you have on the bottom panel, cumulative excess savings, which is been on a downward trend. The title of this slide implies that this trend is going to continue downward. How do you know that for sure?
You get updates on data, whether weekly or monthly. So it could be credit card data. You could be looking at the savings rate. You can be looking at traffic to retailers. And we just continue to see a deterioration across a lot of these data points. And at some point, for instance, in the growth in credit card usage, at some point that has to hit a ceiling where consumers are just overextended. And we're actually starting to see data points where retail spending is starting to turn negative. Traffic has been negative, even for a successful retailer like Ulta Beauty, which is a specialty beauty retailer. Their traffic just turned negative year over year for the first time that I can remember in several years since growth started to return to normal post-pandemic. So you see things like that, and that suggests to us that consumers are going to continue to draw down on those excess savings until you reach a point where we're kind of back to where we were during previous times where you had some economic volatility and consumers weren't quite as well placed to be able to handle it.
Final point on valuations. You have a slide here called S&P 500 price to sales, and you've pointed out that the current ratio is roughly in line with the ratio of 1999 or 2000, so pre-dot-com bust. What does this chart imply, Chance?
So this, you've had a change in margins over the course of decades, and some of that is just higher quality companies being developed. There are some tech businesses and even an improvement in industrial businesses that there's been a bit of a trend higher in profit margins. But sometimes if you're just looking at, say, a price to earnings ratio, if you're at peak profit margins, that can hide that there might be more downside than you anticipate. So a way to strip that out is to look at price to sales, just because revenue growth tends to follow nominal GDP growth in the economy. And that tends to be more stable over the course of decades and changes in the world. So when you look at that chart and see that the price to sales is still at a very high level, similar to what you saw in the late 1990s, that just tells us that we don't want to, if we're buying anything or looking to buy into stocks, don't try and tell ourselves that this is a cheap point in the cycle for us to try and buy assets at a discount. You're still at a point where you could see more downside in the future before you'd really start to think that securities are looking attractive again.
How much downside? Are we looking at a compression in the multiple back down to, I'm looking at 2009, it was all the way down below 1. We're currently still above 2. What are you anticipating for valuations?
We wouldn't anticipate it to that extent. So like I mentioned, there's just been improvement in business quality over time. So margins are just flat out better than what they were in the late 2000s or in the 1990s. So we would say that if you're just looking at the S&P 500 earnings per share number, right now, the forward number is probably about $225 per share, but that's assuming that things can return to growth here pretty quickly. You could make a case that if we see an additional slowdown, that number might be closer to just a little bit over $200 per share. If you put a 16 times earnings multiple on that, you've got about 20% downside in the stock market to what we would consider to be a good entry point and where we would start to get more aggressive and really looking for great opportunities. And just to follow up on that, we've got over 100 different companies that we've vetted that we have buy target prices that we're watching for, that we would be very interested in making a purchase and adding those into our clients' portfolios if they hit those target prices. Some of those more defensive securities might only be 5 or 10% away, but a lot of them, especially on the cyclical side that have done very well recently, you might need a 30% decline to get back to a level that we think is really attractive. So it kind of runs across the spectrum, but that tells us that some of these areas have really run ahead of their fair value and would have to come down by quite a bit for us to be interested again.
Charlie Munger, at his last shareholders meeting, Berkshire Hathaway shareholders meeting, he said that if you're a value investor, expect to make less, were his words. And then, of course, Warren Buffett poked fun of him and said, you've been saying that since we've met. But to his point, I think he's anticipating either slower growth or less opportunities within the value stock space. Is this a sentiment you share?
We would agree. Some of it is just timing of what era your investing career or your investing lifetime sits in. So to Charlie's point, if you look back in 1982 when interest rates were at all-time highs and stocks were trading at less than 10 times earnings, you had a nearly 40-year run there where investing in stocks or in long-term bonds would have worked out spectacularly well for you. Now today, you've got interest rates a lot lower than they were 40 years ago, and stocks are trading at 18 times earnings rather than 6 or 7 times earnings. It's just math that it's going to be harder to generate a great return from this point. But what we would say is that while that requires to be a bit more flexible in your portfolio and just be more aware rather than just buying everything and holding it for a long period of time, you do get these moments every few years where there's a great buying opportunity. We had 2 in the last 5 years. There was one at the end of 2018 on Christmas Eve. That was a great low that ran for a year and a half. Then we had the pandemic hit, but in the middle of March 2020, and even for the next several months afterwards, there were some great buying opportunities that we were able to take advantage of. So right now we're back again towards the top end of the cycle, but all it takes is something that creates some fear and concern and a slower economy, and we could be right back down to a level that we would think is a great entry point to buy a lot of assets in the financial markets. But for right now, we're just still waiting for that next period.
Good idea to go to the next CFA Halloween party dressed as a zombie. Might scare a lot of people and hit close to home. On that note, Chance, thank you very much for your time. Where can we learn more about Oxbow Advisors and your strategies and your work?
Yeah, thanks, David. You can visit our website at oxbowadvisors.com or check out our YouTube channel at Oxbow Advisors.
Yeah, you got some great presentations there, very informative. So check that out. I'll put the links down in the description below. Chance, thank you again for your time today. Appreciate it.
Thanks a lot, David.
Thank you for watching. Stay tuned and don't forget to subscribe.